The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. European equity benchmarks poised to open higher after snapping a 4-week winning streak. Investors eyeing key UK jobs and inflation data, flash PMIs and Fed minutes in the week ahead. The U.S. Iran Memorandum of Understanding expires Monday stateside with end of the war. Well, still deadlocked. President Trump concedes Americans will need to live with high fuel prices.
For you to pay a tiny little bit more for your gasoline, just remember you're doing it so that a very evil country cannot have a country. Really, it's the number one state sponsor of terror in the world.
Meanwhile, Europe continues to reel from heat waves. Wildfires ravage Belgium, forcing hundreds to flee, while water levels in Germany's Rhine River fall to a further record low. Berkshire Hathaway builds up its stake in Alphabet, making it the company's third largest holding, as quarterly filings stateside reveal a big tech tug-of-war among institutional investors.
Right, everybody, lovely to see you all. I haven't been around for a couple of weeks, so I want to know what I've missed. Steve.Sedgwick at CNBC.com. What have I actually missed? Because as far as I can see, the markets have been on a roller coaster ride. We were dumping quite aggressively when I left for my holes, and now the market's back at virtually record levels on the S&P. The love for the AI trade is back again. The love for the broader technology trade is back again. We're seeing some record levels on a whole host of markets. And yet, I see the same strains in the foreign exchange markets I saw 2 weeks ago that I'm seeing with the dollar yen, and real concern of whether that intervention from the Japanese and the Fed actually had a meaningful effect on the medium term. I'm seeing the same strains in the bond market with 30-year auctions looking pretty awful in terms of the highest yields we've seen virtually this century as well. And I'm seeing the same concerns in private credit markets. Story, top of the FT today. Have a look at it as well about some of the big listed players having to take downtick on the valuation of their private assets as well. So what have we got? We've got euphoria in technology. That is back again. We've got concern in the foreign exchange markets, concern in the bond markets as well. Pretty benign inflation story. Let us be brutally honest about it as well. Your data last week was where you wanted it as well. So that has kind of moved the needle just a little bit to slightly more dovish on what the Fed does next as well. But what has changed? What are you actually doing out there? Steve.Sedgwick at CNBC.com if you want to get involved. If not, I'll just hand it back over to Ben. Ben, good morning.
Good morning to you. Yes, let's check in on the picture on equity markets. And this was how the US markets closed the Friday session. All of the three main benchmarks in the red. This was after a week where there was a lot to digest, a week and a bit. We had the softer inflation data the week before, the cooling labour market, which pulled back those bets on the Fed moving higher on interest rates. In fact, there's now a 70% chance of a hold being priced in for the decision next month. On the other hand, on Friday we had weaker than expected consumer spending and sentiment, which again initially led traders to pull back on bets of a Fed rate hike, but then some of that filtered through into the sentiment among equity investors, and we saw that negative close on the three main benchmarks. Of course, in the background, it's easy to forget, isn't it? But they're still grappling with the ongoing conflict in the Middle East. There is no clear resolution or a direction to end the war there. There's also the wobbles around the AI trade. Sometimes we're seeing risk on sentiment, other times we're seeing investors sour on that trade in particular. So a lot for markets to digest. Crucially, this week we get the latest minutes from the Fed's last meeting, which will give us a bit more of an insight into the thinking of the members on the FOMC. So that's the US picture. Worth saying, actually, the markets for the week in the US mostly closing high, with the exception of the Dow, which closed the week around 0.5% down. This is the picture on the Asian markets at the moment. We're saying the South Korean market, the Kospi, closed for a public holiday. It's the only reason it's not on my wall. We haven't forgotten it. And it's mostly positive across the key regional benchmarks. The Nikkei 225 doing not badly at all, up 0.7%, despite some weaker than expected GDP data out of Japan and those moves on the yen, which has given up a substantial chunk of the gains that it had seen after the joint US-Japanese intervention. So we'll keep an eye on that as well. The All Ordinaries in Sydney off by around 0.5%. What's being anticipated when European trading gets underway for the new day and the new week? Well, a positive start to the week. The futures pointing to equity markets here opening on the front foot, all of them up around 1/5% or 1% or more. And what's the picture in the US? Of course, the open on Wall Street a little bit further off. A bit of a mixed picture. Markets lacking clear direction. The Dow looking to slide below the flat line, but the S&P 500 and the Nasdaq both being called higher.
Right, let's move on. Look, my next read says this. Investor attention centres on US borrowing costs this morning. Really? Really? When have any of you lot really cared that much about US borrowing costs to that degree as well? It's only people like me whining in the background about how big it's getting. I'll come to the point in a moment, eventually. Investor attention centering on US borrowing costs, apparently, this morning, after a string of lackluster data-dented sentiment last week. Wednesday's 20-year Treasury auction could well be a watermark for long-term debt appetite. After, what did we see last week? 10, 30-year sales last week saw multi-decade records on auction yields, i.e. the yield was up, the demand was lower, right? Got that? Okay. This as the US national debt clock is on track to hit the $40 trillion mark as soon as... Why do you care about 40 trillion? It's just a number. 40 trillion is just a number. Go down Anita's Way, you know, somewhere between 6th and Times Square, yeah? You got a debt clock in New York. If any of you are there, just have a look up. Have a look up at the debt clock. It now says $40 trillion. It's got loads more info on there. How much you as Americans are paying per person in debt. Why do you care? Why do you care? Well, I'll tell you why you care. Because all we're seeing at the moment is US defence spending doing this, yeah? It's about $960 billion in 2026. But obviously, as you know, Hegseth wants it much larger than that as well. What do you think your interest payments are? Yeah, just over $1 trillion. More, you're spending more on your interest payments in America land than you are on your defence, right? And if you think that's bad, give it 10 years. Give it the middle of the next century. You're going to be paying $2.6 trillion, roughly, on your debt. Anyway, hit the $40 trillion mark as soon as today, just days after July's deficit figure release. A record for the month of $432.3 billion. Bank of America reckons servicing costs that debt is costing is nearly $1.5 trillion over the last 12 months. Wow, that's even more than I said. Freya Beamish, Chief Economist, Global Data, TS Lombard. Freya, lovely to see you. I always learn something from speaking to smart people like yourself. Why is it? My read said investor attention's all about the debt, and yet it's not. They're glibly ignoring it. What's going on, Freya?
Yeah, I think there's ways in which it matters and there's ways in which it doesn't matter. And there's a lot of interactions going on. If you take that debt clock number, you divide it by GDP and you plot it against other countries on a scatter chart, you will find no correlation between government debt to GDP and the level of the 10-year. If you take the deficit and you plot that against yields and yields dynamics on a cross-country basis, you will actually find most of the time, and by most of the time I mean going back to the Second World War, that there's actually a negative correlation between that issuance and yields. Apart from when you have big negative supply shocks in the real economy, and that damages the quality of the bond as a hedge for equities. That's one way in which the issuance starts to matter. And then I think that the thing that's perennially forgotten is who specifically is it that is buying the debt, and how are they funding it? I think we've moved from a situation in which there was a huge amount of duration all the way through the 2010s, amount of demand for duration from real money. So that was funds that were there that were trying to buy this debt and they couldn't. And we flipped to almost the reverse of that, where we're now a lot more reliant on hedge funds to jump in and clear the market, especially out at that 30-year tenor. to clear the market, and they have to fund themselves. So that's where you get all the interactions from, because wherever you have a hawkish central bank, so in the UK, where you have a hawkish central bank and you have already a big stock of duration, so the government debt, but also looking at the average maturity, that's where you start to see significant correlations coming in when you're adjusting for the maturity, and you're looking at what the central bank is doing as well.
Freya, brilliant. Again, how can any of our viewers fail to have learned something from you there? I certainly have. But look, I remember Reinhardt and Rogoff, and I know they made their mistakes on their methodology, and they got punished for that publicly as well. But I'm going back, 15, 16, 17 years about this time it's different paper. And the figure, and you made the key point there, it depends who owns the debt as well. And that was a key point of that. But they had the 90% rule. When it goes over 90%, pretty much things are looking a bit dodgy. So I remember going back to 2007. You and I probably chatted then. And the US debt to GDP then was about 55.7%, 55, 60%, there or thereabouts as well. How is it, and you mentioned a scatter chart as well, so I was paying attention to everything you said there. How is it now that we are so wonderfully relaxed now at financing the world's biggest economies? By the way, that includes China's debt now, which wasn't anywhere near as bad 16 years ago. That we're so glib about it now compared to then, when yet we had a global financial crisis, which I remember also included a global sovereign debt crisis, on the basis of much smaller numbers.
Yeah, I mean, the sovereign debt crisis to me was more about that kind of structure of like more to do with the Eurozone, and the whatever it takes moment was really important in saying, OK, well, we know we don't have exactly the right structures here and a sort of a central bank backing each of these. But then the ECB sort of stepped in. So that was a specific example of where it does matter, and policymakers sort of did the right thing to sort of calm things down. I think the inflation regime is everything. We know that you can have very, very high levels of government debt to GDP and sustain that for a really long period of time. All you need to do is look at Japan, but only in a deflationary environment where the deficit is the result of the fact that the private sector is continuously trying to save, whether that's to deleverage, as we had in the 2010s, and that's when you get the really big rise in government debt to GDP, and nobody cared. Everyone was lapping that stuff up at that point in time. When you have demand-led inflation, which is great for equities, and that's fine. But also negative supply shock-led inflation in the real economy. So all these shocks from the Strait of Hormuz, tariffs, climate change, all of these things are now creating an environment in which the correlation between bonds and equities has moved from historically negative back into what is actually more normal, where you don't get so much of a hedging quality from bonds into equities. So that affects the long end of the curve. And the fact that we're in this kind of more inflationary regime, the last data point notwithstanding, generally now inflation is surprising to the upside consistently over a period of years. And that's not all bad. I think we fall into the trap of thinking that higher yields are always a sort of a bad sign. Often higher yields can be a sign of a stronger economy. But what we have here is a real mix of things, some of them reflecting a good change in the economy from the 2010s. Let's not all be negative about this, but some of them reflecting that deterioration in the geopolitical order, some of them reflecting that greater dependency on hedge funds to clear the market. And there's a lot that the debt issuance managers can do about that, and central banks can do about that with respect to QT and how they manage the curve. That are all lessons that are sort of starting to kind of come through, but haven't really yet been learned, I think.
My poor colleague, I haven't had a question for 2 weeks, so I'm just champing at the bit. But poor Ben, he might get one in about 9:30. But Freya, seriously, you mentioned Japan, and that is the great example of how we can all manage larger debts, because if it's financed by local postal savings and this huge pool of investors locally or savers, it's okay. But they're getting older. I'm getting older. Even you, Freya, but you're nowhere near retirement. You've got decades ahead of you. A lot of people getting older, and they're drawing down. And they're not being replaced by young workers who are going to be saving, because there's less people around as well, as we're seeing from China to Japan to the US to the UK as well. So Freya, and given the tensions we've seen over the dollar-yen in the last couple of weeks, are things not just creaking, but beginning to have kind of, we're having to put more fingers in more holes to stop the water coming through?
I think things are certainly changing very sharply, and Japan is the best example of that. I think we've gone from a place where the Japanese labor market was just completely incapable of generating wage growth. And now we have Japanese wage growth. Can't believe I'm saying this, but I can believe I'm saying it actually. Japanese wage growth above 3%. And that's because they've hit certain demographic turning points, which, that was always going to be the argument that wage growth would come when the labor market was, when the labor supply was contracting. And it just didn't for Japan for a whole host of reasons that I think were very just Japan and time specific. So now we all have a situation globally where labor supply is much, much tighter. And there's a structural tightening of the labor market, and that should feed through to global bond markets in terms of higher yields on a sort of a structural basis. And the fact that Japan has gone from being this deflation nation where it's not necessarily a good thing to be able to finance debt in the way that Japan was, because that was just evidence that Japan was stuck in this deflationary mindset and deflationary economy. The fact that they now have wage growth means that they actually have the possibility now of having private consumption-led growth, but they have to manage the curve. The Bank of Japan needs to make that move and back up the intervention with raising rates. And if they do that, I think that there is still a path for them to sort of move into a more private consumption-led growth place where you would be buying equities and you wouldn't be worrying so much about these fiscal problems. I think that is a very good kind of example of what we're facing globally. I think for the US, it's slightly different. We've got a Fed that is kind of questioning its role, questioning whether it is going to be hawkish or not. And I think the 30-year is actually looking at the economy and thinking, well, there is inflation here. There is the earnings growth is spreading out. I know there's been some kind of weak reads on the real economy recently, but the Fed needs to sort of also get its move on and start hiking as well.
Love it. Thank you so much. What a great start to the show. I'm having an economic treatise from a very smart person as well. A, I love the children's art, as ever. Thank you. B, I've got to ask a question. Is that your microphone in front of you or a small Death Star?
Yeah, it's the small Death Star.
OK, brilliant. Just needed to confirm. Freya, lovely to see you. Thanks very much indeed, as ever. Freya Beamish, who is the Chief Economist at Global Debt TS Lombard. And if you're wondering where Ben is, I have penciled him in for a question at 9:45. I've been away. What do you expect?
I know, great start to the morning. I know. It's lovely to have you back, by the way. We've missed you.
Well, you don't get so many syllables in, that's for sure.
I think that's what it says on the script. We have
missed
you a lot.
Steve, just carry on. Just carry on. I will. The value of troubled private credit loans has hit its highest level since 2017. Shall I say that again? Because some of you lot think it's the golden place to be, private credit. So I'll just say it again. The value of troubled private credit loans has hit its highest level since 2017, according to Financial Times analysis. Loans labelled non-accrual status in the top 20 listed funds increased to a median of 2.8% of their costs in the second quarter, up from 2.1% at the end of the first quarter. The director is insisting that Ben gets 4 words in edgeways. All right, fine, it's your show.
I'm going to do some work this morning, shouldn't I? Yes, Anthropic has reportedly told investors its revenue surged by around 14 times on the year in the second quarter, to come in at $11.5 billion. That is according to Bloomberg, which cites documents saying the company actually posted positive adjusted operating income last quarter. This as investors count down to its expected IPO, which could come as soon as next month, according to the Wall Street Journal. Reuters says the company is being put under especially heavy scrutiny ahead of its debut, with Wall Street banks eyeing its revenue projections for 2028, which apparently top out at $200 billion. Nvidia has reportedly scaled back plans to support OpenAI's proposed 10-gigawatt data center project in Ohio, cutting its guarantee to less than $120 billion, down from $250 billion. According to the Wall Street Journal, investors had expressed concern over the chip maker's risk exposure. The paper says that plans currently being discussed would see Nvidia provide a financial backstop for the first phase. It's around 5 gigawatts of power, before deciding whether or not to lend any further investment. SoftBank subsidiary SB Energy is developing the site. Over the weekend, the information reported that Nvidia is in talks to invest as much as $3 billion in that company. Plenty more coming up on the show, including this. President Trump calls on Americans to accept higher fuel prices as a memorandum of understanding between the US and Iran is due to expire. Plus, the River Rhine hits another record low, wreaking havoc with German shipping. And we'll discuss the outlook for the oil markets with Jeff Curry. That conversation at 9:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
China's National Bureau of Statistics has updated the release time for today's July economic data release to 8 a.m. London time due to a commemoration for former President Jiang Zemin. This, as today's industrial output numbers are expected to show slowing growth, but with an uptick in retail sales.
US President Donald Trump's envoy and son-in-law Jared Kushner reportedly met with the political leader of Hamas in Egypt on Sunday, as the White House looks to secure backing for a Gaza peace plan. Kushner also reportedly met with mediators from Egypt, Qatar and Turkey and is due to meet with the Israeli Prime Minister Benjamin Netanyahu today. The President, Donald Trump, has called on Americans to accept higher fuel prices amid the Iran war. The US leader also suggested he could declare the Strait of Hormuz a US territory, a move he said could happen once Iran is defeated. Traffic through the waterway remains largely stalled, with the UAE accusing Iran of attacking another ADNOC tanker on Friday. Speaking on Friday, Mr. Trump insisted he did the right thing regarding Iran.
For you to pay a tiny little bit more for your gasoline, just remember you're doing it so that a very evil country cannot have a country. Really, it's the number one state sponsor of terror in the world. We don't want to have them have a nuclear weapon. So remember that when you have to pay a little bit more, you're at $4. It's okay. I mean, it's I'll never apologize. I did the right thing.
This as a memorandum of understanding which both the US and Iran signed in June and have since repeatedly accused each other of violating is set to expire on Monday, i.e. today. Dan joins us with plenty more. Dan, I don't know where to start. This comment about declaring the Strait of Hormuz as American territory, did you want to say anything on it? I know what I think, but it's probably not fit for air.
Well, Steve, it seems as if there's more of a narrative war unfolding as we kick off a fresh week of no peace and no war as well. At the same time, this 60-day memorandum of understanding between the United States and Iran expires today with little sign of a revival. Washington and Tehran have spent the last few weeks accusing each other of violating the deal, including over control of the Strait of Hormuz. And then, as you say, on Friday, Trump has said the US could declare the strait American territory. Well, no surprises to see that in reply, Iran's deputy foreign minister said Hormuz cannot be seized by tweet. Tensions on the sea also rising. An ADNOC vessel was attacked in the strait on Friday, the latest in a series of strikes on UAE energy and shipping. The UAE presidential advisor Dr. Anwar Gargash weighing in at the weekend, saying the attacks will not shift the UAE from its policy of deterrence, diplomacy and international law. The focus right now is what happens through the course of this week, and the next big move could actually come from Washington this week. Treasury Secretary Scott Bessent saying new economic measures against Iran are coming, measures he has described as something never seen before. So the key question now is what that means in practice, whether Washington now plans to target Iran's oil exports once again, its shipping networks, banking channels, maybe third countries also helping to Tehran move helping Tehran to move money and energy. It remains to be seen what these new measures look like, but that is the primary focus right now, as the US perhaps shifts away from kinetic military action and pulls the lever when it comes to economic leverage over Tehran to bring the regime back to the negotiation table.
Superb work, as ever. Thank you very much indeed for that, Dan.
Firefighters have been battling Belgium's largest wildfire on record across the weekend. The blaze has destroyed more than 30 square kilometres of land since it began in the High Fens Nature Reserve on Friday, close to the German border. Meanwhile, Germany's Rhine River has hit another record low, falling to just 6 centimetres at the Kalb choke point late on Friday. The river usually lies 1 metre below the gauge and is a key indicator. The low levels have halted shipping, moving most transport to ships and trains. Annetta joins us now. I mean, Annetta, the implications of this, it's become such a serious, damaging situation. Ships being stranded, production cuts in German factories, even the Sunday truck ban has been suspended. Do we have any clear idea about exactly what extent to which this could hit the German economy?
Well, we have various predictions when it comes to GDP hit. So the Institute of the World Economy is expecting that it could hit German GDP by as much as 0.4%. The International Institute of Research in Kiel is saying that it could actually chop off roughly 0.2% of GDP growth in the third quarter. But the effects are probably not contained to the third quarter. It could have longer ramifications as well going forward, because freight rates and costs are increasing for many companies. Currently, the chemical industry, like on average, is just producing at 90% of their capacity because they don't have all ingredients they need, they wait longer, and it does cost all a lot more. And the fact is, or the reason for that is that the Rhine River, even if it's just responsible for 7% of all goods transported, it's a main waterway for goods from the chemical industry, from the petrol industry. And we're already seeing now an interesting divide between the south, which of course very much depends on the river capacity, and the north when it comes to petrol prices. Petrol is cheaper in the north than in the south, just to give you a very practical example. What goods might be affected? It is especially, as I said, petrol and anything petrol related. Construction goods are normally shipped as well because they're very heavy and not just easily being loaded on a truck instead. Then we also have food and like grains and wheat and all that kind of products are also normally transported on ships because they are also very heavy. Anything which is heavy rather goes on a ship than on a truck because it's much cheaper in normal times. But currently, as you said, the River Rhine has hit a new record low. Now it looks like that river levels are somehow slowly coming back. And Mark Schattenberg from Deutsche Bank just early on told me that at levels of 50 to 80, we can say that the situation is normalizing at that choke point close to Frankfurt, and that goods can be transported in a rather normal fashion again.